welcome to our webinar on what a Roth conversion is and what it entails. My name is Larissa Greene with Advanta IRA. Thank you so much for joining us. We're going to go through Roth conversions, kind of take it step by step. We're going to first talk, of course, about the accounts that can be converted to Roths. I will go into some details about pre-tax accounts, and then we'll move on to Roth conversions and how they work. I'm also going to touch on converting assets. I know that was a question that I had from yesterday for the webinar today, so I'm going to make sure to go over that, and I included examples. I also want to point out that I did upload the slides as a handout, so if you'd like to download them, just check your right-hand navigation. You'll see your tool over there for the webinar under handouts. You can download the slides so that you can review them later on. You're also going to be able to ask questions throughout the webinar. We do keep everybody muted, so please just keep that in mind and make sure to type any questions you have into the question box, and I will get them answered as we go. Again, my name is Larissa Greene. I'm with Advanta IRA, and I've been with Advanta for 13 years now. I have done a little bit of everything at Advanta, including things like transfers, new accounts. I have helped people fund transactions and paid expenses on behalf of IRAs. For about 11 years now, I've been doing education, business development, and networking for the company. My direct contact information is here, so if you have any specific questions or maybe want to go over a specific scenario, please feel free to reach out to me. I'll also give my contact information again at the end. Advanta IRA does not provide investment, tax, or any legal advice, and we don't endorse any specific investments or products. So please keep that in mind as we go through the webinar today. We're talking about Roth conversions for educational purposes only. I am not a CPA or accountant, tax advisor of any kind, so please reach out to your tax professional and discuss Roth conversions with them before proceeding. Advanta IRA has been in business over 20 years, and we have over $3 billion in assets under administration. We have two offices. We're in Atlanta, Georgia, and Clearwater, Florida, but we can help anybody anywhere, and every account holder gets a dedicated account manager to assist them with things like making investments, transferring between IRA accounts, and things like Roth conversions. And all of our staff is knowledgeable about the processes for each of these, so we want you to feel comfortable in asking any questions of your dedicated account manager. If you're not with Advanta, and I would encourage you to reach out to us and find out more about getting started, and when you're ready, we're here to help you self-direct your IRA. So we're going to start with a history of not only Roth IRAs really, but IRAs in general. For those of you that were not aware, IRAs were created in 1974 with the Larissa Act, and basically what happened was it was determined that many people were not covered under an employer plan at work for retirement. And so in order to encourage people to save for retirement in 1974, the government said, okay, we're going to allow individuals that are not covered by an employer plan at work to start saving tax deferred for retirement, and really, again, just a way to encourage people to save for retirement. In 1981, the eligibility for everybody, whether or not you're covered under an employer plan at work, opened up. So previously, you could only participate in a traditional IRA if you were not a part of an employer plan. And then in 1981, they said, okay, everybody that has earned income, and that's important, everybody that has earned income can contribute to a traditional IRA. In 1986, the deductibility for a traditional IRA changed. So it was that you could deduct your contributions to a traditional IRA regardless of whether or not you made a certain amount of money and whether or not you were participating in your employer's plan. But in 1986, the government decided to limit that, and that is still in place today. So if you are maxing out your employer plan and you make a certain amount of money, a modified adjusted gross income amount that changes a little bit every year, then you cannot deduct your traditional IRA contribution. You can still make the contribution, but it may not be deductible, or you may get a prorated amount of deductibility of that contribution. So that changed in 1986, and again, that's still in place. So if you think that you might be above that threshold for earnings this year and you do max out your employer plan, you're going to want to check that, and you can do a quick search on the IRS website, and that'll pull up those those limitations for you. In 1997, Roth IRAs were created. So up until now, everything was considered pre-tax, which meant that when you reach retirement age, it would be taxed as ordinary income to you at the time that you take distribution. So up until then, everything was pre-tax, whether it was an employer plan, whether it was a traditional IRA. And so 1997, actually the gentleman that came up with the idea for Roth IRAs, that's who it's named after. They were created to allow people to make contributions after tax, so there's no deduction received when you make a Roth contribution, but then of course the idea being that that money grows tax-free. In 2006, Roth 401ks were introduced. So up until then, all employer plans were pre-tax. And then in 2006, they said, you know what, we're going to allow contributions made by employees or salary deferral to be considered Roth if the plan allows it. So the employer plan that you're a part of has to allow that. And you also have to elect for those contributions to be Roth. And then I guess really we could add to that, because with Secure Act 2.0, the employee and employer contribution can be considered Roth. However, we're still waiting on some specifics from the IRS on that. And so currently, I don't believe any employer plan allows the employer contribution to be Roth. It's coming, but not quite yet. Okay, so let's look at traditional IRAs, and a lot of this is going to be true for pre-tax accounts in general, but we're going to talk about traditional IRAs because we're going to talk about converting traditional IRAs. So anyone with earned income is eligible to contribute to a traditional IRA, and that is very important here, because when you don't have earned income, so if you're either retired or a lot of your income is considered passive, maybe it's rental income, or based on other types of investments, then you would not be able to make a contribution to a traditional IRA. So you have to have earned income. That's the first thing. And then the second thing is the deductibility may be limited, again, based on annual income like we talked about. I had a question pop up, is this applicable to self-directed IRAs? And it is. When we talk about a self-directed IRA, we're not talking about the type of IRA. More specifically, we're talking about the type of investment the IRA holds. So when you come over to Advanta, you're going to establish an IRA account based on federal guidelines. So it could be a traditional IRA, not meaning traditional assets, but we're talking about a pre-tax account. So when I say traditional IRA here, I just mean simply a pre-tax account for an individual, not traditional assets. And so Advanta IRA can hold any type of IRA account, and that includes traditional, but the type of investment is self-directed, so a private investment held by that account. I hope that helps clear that up. I had another question pop up about how much you can convert, and we're going to talk about that, so I'm going to hold off on that in just a minute, but if I don't answer your question, please let me know. So again, anyone with earned income, making sure that the income that you have is considered earned. And then again, deductibility may be limited based on your annual income, but you can still make the contribution. It's just going to be something that's going to be considered after tax, but grow tax deferred. Benefits to a traditional IRA, very simply, tax deduction, lowering your current tax bill, tax deferred growth, so you're kicking that tax can down the road, and when you reach retirement age, you've had the ability all this time to have that grow tax deferred. So when you make an investment, income is going to go back to the IRA without paying taxes, and then once you reach retirement, when you take distributions, the distributions are going to be considered ordinary income in the amount you distribute the year you take the distribution. Another big benefit is former employer plans. I have 401k up here, but any former employer plan can go into a tax deferred account if that money was tax deferred with no taxes or penalties paid at that time. And of course, retirement savings. So when you get to retirement, not only possibly having your Social Security income, but income from those savings that you've put away all those years. Remembering again that there is a deductibility phase out, and there's a table available on the IRS website that you can view in the event that you earn too much. So traditional IRA distribution rules, if you're under age 59 and a half and you take a distribution from your traditional IRA, it's going to incur ordinary income tax, and it's going to be a penalty of 10% for early withdrawal. So a lot of people will call that 10% an additional tax. It's technically considered a penalty, so it's 10% off of the amount that you take as a distribution if you're under age 59 and a half, and then you're going to receive a 1099 for that amount considered ordinary income for that tax year. So once you reach age 59 and a half, you're now considered retirement age for IRS purposes, and that 10% penalty no longer applies, but it's still going to be considered ordinary income to you in the amount you distribute the year you distribute it. And that is just simply because a traditional IRA is tax deferred, not tax free. I had a few questions pop up here. Is there a limit to the amount of earned income you can contribute? Yes, it's $7,000 for 2024 or $8,000 if you're over the age of 50. So the amount you can contribute to a traditional IRA does change occasionally. And so for 2024, it's $7,000 or $8,000 if you're over the age of 50. Keeping in mind, you do have to have that in earned income to max out that contribution. So if this year you had $5,000 in earned income, then the most you can contribute would be $5,000. So I am going to talk about strategies to convert to a Roth IRA. So I'm going to hold off on that question. But again, if I don't answer the question you're asking as we go through the webinar, please let me know. Again, a traditional IRA has the benefit of being tax deferred, possibly giving you a deduction, but you do want to be aware of these rules. And there are exceptions to the 10% penalty if you take a distribution for these reasons. So higher education expenses due to a disability, if you're a first-time home buyer. And I want to point out, first-time home buyer actually has some rules that may apply to people who have possibly purchased a home before. So again, looking into that if that would apply to you, and inherited IRAs. So if you inherit an IRA from a family member or a friend, that actually does mean that the 10% penalty, even if that individual was under age 59 and a half, 10% penalty will not apply. Rules for inheriting an IRA: if the spouse is the beneficiary, then the spouse can treat that IRA as their own, and this is true whether or not this IRA is traditional or Roth. And if the beneficiary is not a spouse, then the IRA must be distributed within 10 years. And we actually have a webinar on inherited IRAs. So if you'd like to learn more, please let me know. Send me an email, and I can definitely send you our webinar on inherited IRAs. So now we're going to talk about a Roth, and it's kind of compare and contrast here on why they are different. So anyone with earned income, again, can contribute to a Roth IRA, but you cannot exceed certain income limits, and we're going to talk about that. So again, if you have earned income and you do not exceed the modified adjusted gross income limits for the year, then you can contribute directly to a Roth IRA. And so if you do exceed those income limits, there might be a reason then that you use a strategy called a backdoor Roth IRA, and I'll talk a little bit about that. And I go into more detail on backdoor Roth IRAs in a separate webinar, but we'll talk a little bit about that and why you would do that. So a benefit to a Roth IRA is tax-free earnings and no taxation on withdrawals. So when you reach retirement age, you can take distributions without paying tax. There are no mandatory withdrawals, so no required minimum distributions for a Roth IRA. And you might be in a lower tax situation this year and expect to pay higher taxes in the future. So again, you don't get that deduction for making the contribution, but you might say, you know what, I'm okay with not getting a deduction. I'm going to make this contribution so that when I reach retirement, my distributions are going to be considered tax-free. And then distributions are also tax-free to your heirs with certain stipulations in place. So if you make too much money, you can contribute directly to a traditional IRA and then convert it to a Roth, and that's called a backdoor Roth IRA. So I mentioned that there are income limits on contributing to a Roth IRA directly. So here they are for you, and this is right off the IRS website. This also does change every year. So this is for 2024. As we go into 2025, if you're looking at making Roth contributions, make sure every year that you're checking this. If you're coming close to those income limits, it adjusts and goes a little higher every year, but just be aware of that because that's going to be really important. So between 230 and 240,000, you can make a prorated contribution to your Roth IRA. If you make 240,000 or greater, you're not going to be able to contribute directly to the Roth IRA. Again, you can use that backdoor Roth, meaning that you make a contribution to your traditional IRA and then immediately convert it to the Roth, and anyone can do that. There's no income limit to convert to a Roth IRA, and you can convert any amount. So if you make an annual contribution of $7,000 to your traditional and you want to convert 100% of that to Roth, you can do that. If you want to convert a portion, you can do that as well. If you're married, filing separate, and you've lived in the household at some point during the tax year, then the amount is 10,000 or greater. So, that's not a ton of money. So if you make 10,000 or greater and you're married, filing separate, and you've lived with your spouse at some point this year, then the modified adjusted gross income is 10,000 or greater. And then single, head of household, or married, filing separately, and you have not lived with your separated spouse at all in this tax year, then it's 146,000 to 161 is going to allow you to make some prorated contribution, and then anything 161,000 or greater is going to mean that you cannot contribute directly to a Roth IRA, but you can still use the backdoor Roth in order to get money into a Roth IRA. I had a few questions pop up. Just bear with me for just a second so I can review them. So I had a question about earned income, and this is where I'm really going to lean on your tax professional for guidance. Typically, earned income is something that you're paying FICA on. If you're self-employed, there's going to be different forms you're filing your income on, and so it could be W-2, 1099, some Schedule C, some K-1 income is going to qualify, and so I would check with your tax professional to see if your income, if you're not sure if your income is considered earned and will allow you to contribute to an IRA. Can you put money into a Roth IRA if you're over a certain age? Yes, you just have to have earned income. And a Roth IRA has always allowed you to contribute as long as you have earned income, but actually with the Secure Act, the original Secure Act, they also now allow you to contribute to any type of retirement account as long as you have earned income. So that earned income is going to be really important here. You can contribute, but you do have an annual limit. So regardless of your earned income, you do have to pay attention to the contribution limits for each year, depending on the type of account that you hold. And actually coming up in the next couple of months, I think next month, I'm going to have a webinar on all the different types of accounts and what the benefits are to them so that you can, check that out if you're not sure what type of IRA account you'd like to have. We're going to talk about how much you can contribute and who qualifies. So that's going to be a great webinar coming up next month. But just keeping in mind, as long as you have earned income, you can contribute to a retirement account. And then depending on what your modified adjusted gross income is, you may be able to contribute either directly to the Roth or use the backdoor Roth strategy in order to get money into the Roth IRA. So Roth IRA distribution rules, 10% early withdrawal if you're under age 59 and a half. It does not apply to contributions. So this is actually different than the traditional IRA or actually any other retirement account. If I put $7,000 into my Roth IRA this year, I can take up to the amount I've contributed over any number of years out of my Roth IRA tax and penalty free because I've already paid taxes on that amount. And it comes out of the Roth IRA in basically the order it's been contributed. And so if I put that $7,000 in this year and I put $7,000 in come next year, then in 2026, I can distribute up to $14,000 without tax and penalty because those are contributions I've made over time. So that's a benefit to the Roth IRA. If there was some emergency and you needed to take a distribution, you could do so without tax and penalty up to the amount you've contributed over time. It is tax-free income as long as two things are true. One, you've reached age 59 and a half, and two, your Roth IRA along with your first contribution has been established for a minimum of 5 years. So that's called the 5-year aging rule. And so as long as those two things are true, when I reach retirement, distributions from my Roth IRA are going to be completely tax-free. Exceptions for the 10% penalty again include higher educational expenses, disability, first-time home buyer and inherited IRAs, and more good news on the Roth IRA, you do not have to worry too much about when you've made contributions versus your earnings because there are ordering rules for Roth distributions. Your contributions always come out first, then your conversions because they're subject to a 5-year rule, and we're going to talk about that as well. And then your earnings are distributed last, and that just happens. You don't have to think about that. That's just IRS rules. I had questions about Roth contributions and conversion timelines, so we're going to talk about that as we kind of go through the webinar. But here is a side-by-side comparison for you of traditional and Roth IRAs, so tax deductions for this year or last. It's going to be a traditional IRA in most cases. And again, looking at whether or not you're maxing out your employer plan. And if you earn too much, you're going to have a prorated amount of a deduction or possibly no deduction at all, but you can still make that contribution. You have tax deferred growth really in both accounts, but technically the Roth IRA, of course, is tax-free. Making contributions past age 72 or 73 and beyond, both of these accounts now allow this. So as long as you have earned income, you can contribute. Flexibility with distributions, that is true for both of these accounts. However, remembering that a traditional IRA is going to have a required minimum distribution past age 72 or 73, depending on when you turned age 72, you have a required minimum distribution. With a Roth IRA, you're increasing your net income upon retirement, meaning that because this distribution is not taxed, it's going to be a net increase on your income. The account that does have income limitations as to whether or not you can contribute directly is going to be the Roth IRA. And then flexible contribution distributions is again the Roth IRA, meaning that when you make a contribution, you can take that out at any time at any age without tax and penalty per IRS rules. I had a question pop up: if I have a Roth IRA at another institution, does that apply to the 5-year aging, or is the 5-year per each account opened? It is per person. So if you have a Roth IRA somewhere else and you open a Roth with Advanta, that 5-year aging is carried to the new IRA. So as long as you have a Roth IRA in existence, then that 5-year aging is going to be carried throughout your Roth IRA accounts. And you're going to see there is an exception with Roth conversions. Roth conversions have their own 5-year aging, so keep that in mind. Depending on what your Roth conversion strategy is, if you convert over time, then each year that you do a conversion, that amount and the earnings attributable are going to have their own 5-year aging. Great questions, guys. Keep them coming. So will Roth IRAs ever be eliminated? That is a concern we see a lot of times, and sometimes we'll even hear that in an election year, regardless of who's running. And we don't think so. Our opinion is that, the IRS does benefit from Roth IRAs and, of course, Roth conversions. If you think about taxable income and when a person pays taxes, I think that regardless of when you contribute or what type of contribution you make, the IRS and the government is going to benefit. And, sometimes you have to think about whether or not, they would have created Roth IRAs if they didn't think in some part that would be good for them. So, if 100 people make a $5,000 contribution to a traditional IRA, that results in $500,000 worth of tax deductions in that year. But if taxpayers' average tax rate is 20%, then this results in $100,000 less in tax revenue that the government receives, multiplied by the number of people making contributions. When an IRA owner takes distributions, the IRS or the government will receive the tax revenue on those distributions. But with Roth IRA contributions, those same 100 people make that same $5,000 contribution, and the IRA or the IRS is going to receive that revenue in the year the contribution is being made. And so they're receiving it in that year versus years down the line when you take distributions. And so I don't see them taking away Roth IRAs just very simply because of that. It's, revenue to them now versus later. And so it's really kind of a good balance if you think about it in those terms. So we think that Roth IRAs will stick around. So what is a Roth conversion? It's simply taking pre-tax contributions or a pre-tax amount of money from a traditional IRA. It could be a SEP, a simple, an old 401k, or even if your employer plan allows it, you can do it within a current 401k plan, but taking a pre-tax amount and converting it to post-tax. So now it's either a Roth 401k or a Roth IRA, and sometime in the near future it could be a Roth SEP or a Roth Simple. But essentially you're electing to pay taxes the year you do the conversion, keeping the money in a retirement account, but now instead of growing tax deferred, that money is going to grow tax free. And remember that tax free growth has to have a 5-year period at which it ages before you take a distribution so that it can be completely tax free. I had a question pop up. Can I convert my inherited IRA to a Roth? Unfortunately, inherited IRAs cannot be converted. I do believe there is an exception for employers' plans, but IRAs that are inherited cannot be converted. I don't know if they'll change that in the future, but currently that is not something they allow. So Roth conversions must be done, and this is one of the questions in the chat. Roth conversions must be done by December 31st, not April 15th of the following year. And that is a question we get a lot, and a reason that we do this webinar a couple of times before the end of the year. We're kind of, highlighting that deadline for you so that if you're going to do a Roth conversion, now is the time to get your tax professional involved, talk to them about the tax implications of that conversion, and making sure that you have that paperwork completed before December 31st. And remember that this is a busy time for your institution. So I would reach out to them, find out what their process is for a Roth conversion, and make sure that you're getting that done before December 31st, because we're at the downward slide of the end of the year. It's September. I can't believe it's September. I'm sure many of you feel that way as well. And before you know it, it is going to be December 31st and even January 1st. So if you want to do a Roth conversion, you have to do that before the end of the year. Please do not confuse that with the April 15th deadline of making an annual contribution. So traditional and Roth IRAs have an annual contribution deadline of April 15th. However, if you were going to do a backdoor conversion, for example, if you make your Roth contribution for 2024 into 2025 and you do the conversion is actually going to count for 2025. You cannot backdate that for 2024. So that's very important. There's no modified adjusted gross income limit for converting a Roth IRA. Anyone can do it. If you're converting an asset, we do have to have a fair market value of that asset to report on the 1099, and I'll talk about that. And I have an example because I know a lot of you are looking at your assets and saying, hey, I anticipate the growth of this asset to continue to do well, and so I want to convert it before I have all that as ordinary income when I want to distribute either the asset or the earnings. So we'll talk about that. The amount converted is included in your taxable income for that year, and it can even bump you up into a higher tax bracket. And the taxes are not paid by the IRA. That is super important. A lot of times when you take a distribution, if you have taken a distribution from your IRA account, you know that we can do some withholding for you. And when you take a distribution from an employer plan, they're required to do withholding. But when you do a Roth conversion, withholding is not done by the retirement account. So this tax burden is to you. It's not to the retirement account. It's reported on a 1099 at the end of the year for that tax year. You cannot convert for prior years. And once you do a Roth conversion, it cannot be undone. It used to be that you could do a conversion, and if you found that this was not the year for you to do the conversion, you could undo it essentially. You can no longer undo a Roth conversion. So be sure with your tax advisor's help that this is the year for you to convert. And we'll talk a little bit about why people convert in certain years and why people do it over time as well. So if your modified adjusted gross income is too high, you can use a backdoor Roth contribution in order to get money into the retirement account and then ultimately move it over to a Roth. And you can do that at any time, just keeping again in mind that if you make a 2024 contribution after December 31st, it's going to be converted for the 2025 tax year because we cannot backdate a Roth conversion like we can a contribution. I had a question pop up. Can I convert existing traditional 401ks with my employer to Roth? That's a great question. It's actually going to depend if you're currently participating in that plan on the plan rules. So IRS says yes, but each plan gets to dictate whether or not they're going to allow an in-plan Roth conversion. So you have to reach out to the plan and find out if they're going to allow you to do that. I had a question pop up. If the owner of a Roth IRA passes away before the 5-year aging is complete, how does that affect the 5-year aging? Has to it's still going to continue on. So the account still has to have that 5-year aging. So even if the IRA holder passes away, the 5-year clock is still in place and ticking. Okay. And there are some other things that go along with that. I don't want to get too much into the weeds on this webinar, but please feel free to reach out to me if you have a specific situation that you're looking at. Okay, so we're going to go on here and talk specifically about why you may want to convert and why you may not want to convert. And so if you have if you're expecting large returns on an investment in future years, so we talked a little bit about that. So if you're going to go ahead and make an investment, you can do that 2 ways. You can convert before you make the investment so that the investment is made through a Roth IRA and therefore it has tax-free returns at retirement. Or if you've already made the investment and you're expecting larger returns in future years, you can convert that asset. I'll talk about that. You have a long time before retirement. So, you know, our younger listeners, if you are starting out and you want to start a Roth IRA, you have a long time before you retire. You might consider doing a Roth conversion of any assets or cash that you currently have in a pre-tax account, because you can wait the 5 years. You're not going to take a distribution right away. You can afford the taxes, or you have time to convert over time. That might be another reason to get started with Roth conversions. If you expect to be in a higher tax bracket in the future versus where you are now, sometimes if you're closer to retirement, you may not, and we'll talk about that on the next slide. The traditional IRA contributions that you make are not considered tax deductible because you make too much money and you max out your employer plan, then you might do a Roth conversion. Your assets within the IRA currently have depressed values. So if you own a rental property that you've owned in your account for several years and maybe the value has gone down a little bit, then you might look to convert because this might be the year before that asset grows in value again. If you have losses to offset the income from the conversion, a lot of times we hear people reach out to us and say, hey, my accountant said this is the year to do a Roth conversion because I have losses this year to offset the tax bill that I'll receive from doing that conversion. You might do it for estate planning reasons. Remember again that I mentioned that Roth IRAs distribute to your heirs tax-free, again, as long as it has aged for 5 years. So after 5 years, if you pass before then, they just have to wait basically for that 5 year to fit those 5 years to finish, and then they can take distributions tax-free. With some stipulations, and then your ability to pay the tax due on the conversion, you know, it happens to be this year, then that might be the year to do the conversion. And again, remembering that it's not withheld and not paid by the IRA. And sometimes people say, well, I'm going to take a distribution to pay those taxes. Remember that if you take a distribution, it's a 1099. When you do a Roth conversion, it's a 1099. So if I convert 100,000, I'm going to receive a 1099 for that conversion, and then I take a distribution from that account, it's another 1099. So I don't like to use the term double taxation, but there it is. It's 2 1099s for that year. So keep that in mind. Why wouldn't you convert? If you're closer to retirement, you don't want to wait that 5 years before being able to take distributions. If you're in a higher tax bracket now while you're working, but you're getting ready to retire, your tax bracket might go down if you don't have as much in ordinary income. And so it might not make sense for you to do a Roth conversion. Again, if you'll be in a lower tax bracket at retirement, or your asset values are inflated and you don't want to do a conversion and incur that tax bill, you don't have available cash to pay the taxes that will be due upon the conversion. If the income from the conversion may result in a loss of other benefits, so keep in mind child tax credit, Medicare premiums, or you want access to the funds within 5 years. So if you do that conversion, remember every year that you convert, the amount converted in that year has to wait 5 years before being completely tax-free. So to convert assets versus cash, you will need a qualified fair market valuation from an independent third party and documentation to transfer ownership. And we're talking here about deeds, assignments, re-registrations of different types of assets. It's going to depend on the investment that you hold and that you're converting. And I do have an example of that. So I had a few more questions pop up. Bear with me as I review them. So the fair market value doesn't take into account the potential growth, and that is true. The fair market value is going to be based on the value as it is within the 30 days of that conversion, which is why we require for you to have it evaluated by an independent third party saying this is the value at the time of the conversion. So, if you said, hey, this is going to be a windfall return in 5 years, but today's value is, 1, 2, 3, ABC, whatever it is, then that is the converted value, and that's the amount the 1099 will be for. Who would provide a value depending on the type of investment? If it's a real estate syndication, who could provide a value for that? That's a great question. A lot of times we will rely on your tax professional for values, but if you're invested with something like a limited partnership or a syndication, at times, depending, we can take a value from them. They have to be willing to sign the fair market value form and provide a statement of that asset. But at times that will work as well. And if you have a specific scenario, please feel free to reach out to me, or if you hold your assets with Advanta, you can reach out to your account manager and they can let you know what would be required for that Roth conversion. Can a realtor qualify the value? No, if you're doing a conversion of real estate, we do need to have an appraisal for that piece of real estate. Okay, so qualified fair market valuation must be provided by an independent third party who is qualified to value that particular type of asset. It can be a CPA or a tax professional, an attorney, an appraiser. All valuations must be done within a reasonable amount of time. We say within the last 30 days prior to the time of the conversion so that the accurate values are obtained and reported on the 1099. Acceptable fair market valuations for real estate, it must be an appraisal on a subject property by a qualified real estate appraiser. Notes, the fair market value of the loan or note would be the outstanding principal plus any unpaid interest. For LLCs, corporations, and partnerships, if there's a manager, president, or officer, they are not considered independent, then an independent third party will be needed. Again, I think we make exceptions depending on the type of investment here. So we can take the value from certain people within, real estate syndications and things like that. But I do think it's important to reach out to your account manager to make sure that the person that you would like to have value it would qualify. So make sure that you're reaching out to us. And then if you have other assets, and a lot of people do when you're talking about self-directed space, reach out to us and we can give you guidance on what would qualify as an independent third-party valuation. I had a question pop up. Does the county property appraiser qualify? Not for a Roth conversion. And so if you're a client of Advanta, you might be thinking about our requirement for an annual value of your assets, and we can accept the county property appraiser for an annual value, but not for a conversion because it's a taxable event. So if you have a required minimum distribution, or if you're doing a Roth conversion, we do have to have a independent third party value it, and in the case of real estate, it is going to be an appraisal. Advanta creates the 1099, so that's a question that I had pop up, and in the examples I'm going to go over, you're going to see that, but Advanta will create the 1099. And can I convert my 401k from a previous employer into a Roth this year? Yes, you can absolutely do that. We can help you with that. We establish the Roth IRA and then you do the rollover. You can either do a rollover directly to a Roth. It's Roth, a direct Roth rollover contribution, or if your old employer plan wants the money to come to us first, we'll set up a traditional IRA to receive those funds, and then we can do a Roth conversion for you once we receive the funds. So let's go over our examples, and we're going to start with Jason's traditional IRA. It has $100,000, and he'd like to do a partial conversion of $25,000. And in this example, I said a partial conversion because I just want to highlight that you don't have to convert the whole account. You can convert over time, or if you just have an investment coming up that you want to use a Roth IRA for, you can convert just what you need for that investment. Your Roth IRA and traditional IRA could also potentially partner into an investment. So if you do a partial conversion and then you want to partner those IRAs into the investment to have partial tax deferred growth and tax-free growth, you can do that as well. So in this example, Jason completes a Roth conversion form with Advanta IRA and indicates the amount he would like to convert. He's going to open a Roth IRA so that it has a home. So basically we have to convert, create an account for the conversion. Advanta IRA will perform the Roth conversion and issue the 1099 form to Jason at the end of the tax year for $25,000. The converted amount is considered ordinary income in the tax year the Roth conversion is performed. Remember, taxes are not withheld by the IRA. So Jason needs to be prepared and speak with his tax advisor that he's going to receive a 1099 for $25,000 for 2024 because that is the year that the amount was converted. The converted amount of $25,000 has to age for 5 years in order to be completely tax-free per IRS rules. But during that aging period, Jason can invest those funds. That's a question I get a lot. Well, if I have to wait 5 years, does it just sit in cash? No, you can definitely invest that $25,000 in this example. It just, if you take distributions, it's not going to be completely tax-free. Each year that Jason does a Roth conversion, the newly converted amount has its own 5-year aging period. And so this is where, making sure that your accountant is aware of any conversions that you're doing would be a good thing so that you know when those 5-year aging periods will end. But of course, you can always get a statement from your Advanta account and see when those conversions took place and in the amount. So I'm going to talk, I see a few other questions pop up, but I think I'm going to answer some of those as I go through this example about converting assets, and then I'll go back to those questions and just, again, make sure you're typing in your questions. We're kind of coming to the end of this webinar. Jason's traditional IRA has a rental property that he would like to convert to a Roth. He purchased the property for $150,000, and I want to point that out because a lot of times people will say to me, but I bought the property for $150,000, so why can't I convert it at the $150,000 value? And remember, we have to have a certified appraisal done within 30 days of doing the Roth conversion. And so now it has a value of $250,000. Jason will open a Roth IRA. Advanta will provide him, Advanta will have him provide an appraisal of the property, a Roth conversion form, and our fair market value form, along with the Roth paperwork. I'm sorry, I duplicated that, but all of that paperwork needs to be turned into Advanta, and we are going to ask to see the appraisal, so we have to keep that on file. And then once we have all of that, we will work with Jason on the conversion. Now, because this is an asset and not just cash, we also do need a deed prepared showing the transfer of ownership from the traditional IRA to the Roth. So there's one more extra step when you're talking about an asset. So that might be an assignment of a mortgage or deed of trust. That might be a deed to show the transfer of the property. That might be an assignment of an LLC or a limited partnership. There is an extra step when you are converting an asset. Advanta will execute the Roth conversion of the property at the current value, so at that $250,000 value, and issue a 1099 at the end of the year so that Jason can work with his accountant to pay those taxes on the converted value. It is treated as ordinary income. So even though this is an asset, that $250,000 is going to appear as ordinary income the year Jason does the conversion. Just like with their cash Roth conversion, taxes are not withheld or paid by the IRA. The Roth conversion must age for 5 years in order to be considered completely tax-free. But again, during that 5-year period, it can continue to be invested. Earnings can be invested from there, so you can continue to grow your Roth account, but distributions would not be completely tax and penalty free if you did not wait that 5-year aging. I had a few questions pop up. Let's see. Is there a way to split up the conversion on a real estate asset? Yes, you can do that. You would do a certified appraisal and then let us know what percentage of that asset you are converting. And we have seen people, and this, again, this is something to talk to your tax professional about, but we've seen people do the appraisal at the end of December. They do a Roth conversion in December of a certain share. So let's say they do 50% in December, and then they continue with the rest of the Roth conversion of that asset in January. And now you've basically spread out that tax burden over 2 years without really having to get an extra appraisal done, or you can definitely do it over time. So if you're like, well, I'm going to convert 10% of this asset every year, just keeping in mind, again, the 5-year aging rule. And every time you do a conversion, you'll need an appraisal and a deed to show the change of ownership percentages. Okay. If someone wants to convert a stock portfolio, do all the positions need to be closed? That is really a question for your stockbroker. That I don't know, because we don't do it. I don't think so, though. I think you can do an in-kind conversion with your brokerage firm. That would be a question for them. It's very likely that because the value is based on what those assets are trading, you don't need to worry about obtaining values on your own. It would just simply be a Roth conversion, and I would imagine they could do that in kind, meaning they don't have to cash those out. What is the tax rate? It's just going to be ordinary income. And remember, at the beginning of the webinar, I mentioned that it could even bump you up into the next tax bracket. So Jason's tax rate is going to depend on what his tax bracket is currently, and the potential of taking $250,000 into ordinary income really could be that it's going to bump him up into the next tax bracket, or more than one tax bracket. So keeping that in mind. I had a question, the charge for each conversion and where the funds are placed for the investment. I'm not 100% sure. I understand your question, but Advanta doesn't charge for a Roth conversion. We just simply help you with it. If you don't have a Roth IRA with us and you need to establish one, it's $50 to open the account. But there's no additional or separate fee, I should say, for the Roth conversion. It's just something we help you with. Who orders or sets up the appraisal for the asset? That would be you as the account holder. You can hire, who you choose to do the appraisal or valuation of that asset. If you're not doing an appraisal, let's say you have a different type of asset like a syndication, please again check with your account manager to make sure the person you'd like to have evaluate that asset would qualify for evaluating that asset before you go ahead and have them do it. I don't want you duplicating your efforts. So with the real estate value, since it has to wait 5 years for aging, can rental income be pulled out before the 5 years? No. The rental income can be pulled out, but it won't be tax or penalty free because it has not aged. So because that rental income is going to be considered earnings on the converted amount, it is not going to be tax free until it ages for 5 years. I had questions pop up about lowering the values of assets. I'm not going to go into that, and I would strongly suggest that you talk to your accountant about the valuation and what that fair market value would be. Does Advanta manage self-directed IRAs? We manage self-directed retirement accounts in the way that we hold private investments. So if you're asking about a brokerage firm account where you can choose assets within the market, we do not do that. We only hold private investments. So we're filling the gap in the industry for private assets held by individuals. So things like real estate, gold and silver bars and coins, limited partnerships, private stock, but we don't hold anything publicly traded. Okay, pros and cons, and we talked a little bit about this really already, and we are coming to the end of the webinar, so just make sure to get any questions you have typed into the chat box, or you can also reach out to me by email or phone after the webinar, and my contact information will be posted again. Everyone's situation is unique. I think we get this question all the time, which is better? It just depends. The answer is it depends. A lot of people really like Roth IRAs because they grow tax-free, but again, how close are you to retirement? Can you wait the 5 years? Do you want to bring the amount you convert into ordinary income? Age and projected returns are the most important factors here, so keeping that in mind. Work with somebody who can advise you on this. Advanta cannot advise you. We can only talk to you about the pros and cons. We cannot say this is the right situation for you or the right time. So making sure that you're talking with somebody who can advise you, and don't miss the deadline. If this is something you're considering, I know a lot of us will meet with our tax professional January, February, March before the April 15th deadline, but don't wait. Meet with your tax professional now so that you can set aside a plan and be ready before that December 31st deadline. We have events going on all the time. I already mentioned one webinar I have coming up where I'm going to actually be talking about the different types of accounts and their benefits, so that that will hopefully help you determine which type of account is right for you. I will be talking about individual savings accounts like traditional and Roth IRAs, but I'm also going to talk about accounts for the self-employed. So 401ks, simple IRAs, SEP IRAs, these are all really great accounts, and they are not all or nothing strategies. Many of our accounts can work together. So if you're interested in learning about the different accounts and which ones can work together, please join us for that webinar, and you can check it out on our events page at advantaira.com/events. All of our webinars are recorded, so you can go back and review them at any time in our video library or on YouTube. And check out our blog, because we're always staying up to date and talking about things that are relevant not only in the industry, but also deadlines and things, year-end strategies as well. So very important to follow along. I can help with some tax advisors. So if you don't have a tax professional that can assist you, we definitely can refer you to some tax advisors or professionals that have helped our clients in the past. So please, again, send me an email. I'm happy to send that information to you. I don't know where there might be Roth conversion calculators, so I'm sorry I can't help you with that. But again, instead of relying on a calculator, I would suggest talking to a tax professional. Here's my contact information for you again, in case you'd like to reach out to me. I am available to answer questions. We can always set up a call, and I have many webinars in our archives. I talked a little bit about investing with smaller amounts of funds. So if you're looking to make a Roth conversion and you don't want to convert the whole amount, I have a webinar out there on using, even just an annual contribution to make investments. We also have different webinars on the mega Roth or contribution to the 401k and Roth conversions. We also talk about investments and fair market values more specifically in some of our webinars. And so I would just encourage everybody, either reach out to me if you have a specific topic you're looking for, because I can probably find them a little quicker in our library, since our library is it's gigantic at this point. Or you are welcome to browse and select videos. If you have a topic you'd like to hear about, please, again, feel free to email me. I would love to hear some feedback. Thank you so much, everybody, for joining. I don't see any additional questions at this time, so I'm going to close out the webinar. I hope everybody has a great rest of your day.